Well, we're never gonna get that time back. Today was one of the most boring days we've had in a hot minute in the world's largest casino. By the time the dust settled on the day, we went nowhere. Throughout the day, yeah, we went a little bit up, we went a little bit down, but nothing happened. In this video, I'll be quickly covering all the major news of the day, but I want to spend most of the time focusing on what to pay attention to tomorrow, because today we came this close, can you see it? I'll put it up there, that close to a major market breakdown. Not only do we have interesting developments on the technical side of the things, but also on the world of options, option structure. So I'll be explaining all of that, and on top of the major macroeconomic report coming out an hour before the market opens tomorrow. So obviously we have a lot to chit chat about. If you enjoy these types of market breakdowns, don't forget to like, don't forget to subscribe. And I did want to take one quick second to say, if there's anything else you guys want in these daily breakdowns, let me know in a comment below, because I'm more than happy to include it. So whatever's fresh on your mind, let me know in a comment below. With that being said, let's rock. Dow posts back-to-back losses Thursday as Trump's auto tariffs weigh on stocks. That makes it sound like today's trading session was a lot more exciting than it actually was, because in reality, we started off weak, then we pumped, then we dumped, then we pumped, then we dumped, and we pretty much ended right where we started. So yeah, things were slightly red in both the SPY and the Qs, but nothing really happened if you were an active J trader, a scalp trader. If anything, you might have got lucky catching those waves, but if you were looking for a big move on the day because of Trump's discussion with tariffs and the automakers and the upcoming inflation report, no, we did not get a nice trend to actually play off of. So depending on your time frame and how long you like to sit in this stuff, yeah, you might have made some money, but today was a day that selling premium is really the way that you could have pumped those bags up. Anyway, we did start off with a bit of enthusiasm. You can see here the GDP report announced at 8:30 a.m., an hour before the market opened, came in slightly higher than expected. Obviously, the market liked that. And on top of it, initial jobless claims came in at expectations. So this removed some uncertainty from the system, especially because recently the uncertainty was up due to what in the world is or isn't happening with tariffs. So quickly wanted to show you that. I also wanted to show you that the options market fully agreed with the fact that we did nothing today. When the market opened, options pumped. When the market dropped, so did options. When the market pumped, so did options. When we dropped, guess what? So did options. Most of the movement today was due to zero DTE trading on both the call and the put side. You can see it here on Spot Gamma that it's just when they're so tightly coupled. These are the zero DT calls. These are all expiration put together. Zero DT puts, all expiration put together. The fact that they're so tightly coupled means that it was the zero DT trading on both the call and the put side that was really running the show. There wasn't any major bets as of now being made for tomorrow. There was a couple things that I saw that I'm going to call out to you, but you just need to know from a volume perspective, it was just a zero DTE day. And then that brings us to how crazy it was. Like, I get that maybe this was whipsaw, and if you're like me, this is just a boring day, nothing really much to do. But if you look at the low of the day, I find this to be fascinating because we were this close to a legit breakdown. So first of all, you can see that the open and the close, nothing, doji candle, but look at the low of the day. 564.94. The downside gap fill was 564.89, as in we were off by just 5 cents. And it was also apparent on SPX. Actually, that one was even more brutally close. You could see that today's low was 5,670.94, and the downside gap fill was 5,670.84, as in off by 0.1. So that gap is still there, and also the gap happens to be right at this upward sloping trend line on SPX and SPY. So the question is, and also if you're a technical trader, let me just show you on SPX because the chart's a little bit cleaner. This will be referred to as a bear flag because here's the flagpole, then you have higher highs, higher lows. You get what's referred to as a bear channel. Even though it's trending up, it's called a bear channel because it breaks down. So it's either a bear channel or it's the flag of the overall flagpole, whatever, it doesn't matter. There's so many names in the world of technical analysis for the exact same thing. So call it what you want, but really what you need to know is pay attention to does this trend change? Does this actually snap? Because recently we have a little bit of a bullish trend to the upside. Is it going to be ending soon? And potentially, is it going to be ending tomorrow? An hour before the market opens, we have the PCE report, the personal consumption expenditure. This is a very important inflation report. And in fact, according to the Fed, it's the one that they care about the most, the one that they give most weight to. The other one that you probably hear about is the CPI report, the Consumer Price Index. They're very, very similar. The major difference is the PCE is a little bit more timely in the data that it gathers, and it's also a little bit more broad in the data that it gathers, but that's pretty much just a nuanced difference. But for anyone who wants to know, that's what the major difference is. So this is obviously coming out an hour before the market opens tomorrow. I looked at the last 10 PCE events, and those are all marked out with these white horizontal lines. And I told those nerds in the lab to do some number crunching for me to give to you the results. So unfortunately, there's not much going on there. In terms of the price action from open and close tomorrow, the day of the event, over the past 10, 5 were red and 5 were green, a perfect 50-50 split. In terms of the open tomorrow relative to today's close, 5 were gap ups and 5 were gap downs. So pretty much 50-50. But what is interesting is if you look at the red and green days just from open to close for tomorrow, there's no clear pattern. It's pretty much green, red, green, red, green, red, or something along that. But what is interesting is the recent change. So even though we have 5 gap ups and 5 gap downs, the recent change is actually out of the last 6, 5 of them were gap downs. So in recent history, the market at market open is reacting pretty poorly relative to close. So basically, if you decided to swing some puts overnight, I think that's actually a pretty smart play just based on the pure stats, and also the fact that we closed below 5,700, a very important level, and also the fact that we have not yet gotten that downside gap fill. And if we were to crack that, well, pretty easy puke down to 5,600. Speaking of 5,600, let me show you this. This is the current open interest for Friday's expiration. Notice how the biggest node is 5,650. We also have a lot of action at 5,675, and the third biggest one is all the way down here at 5,600. So right now for tomorrow's expiration, you're seeing that the puts are outpacing the calls by a good 30 to 40% with huge nodes. Once again, write these down, 5,675. That's not only the downside gap fill, but also that trend line snap. Then you have 5,650, which is just clearly massively important. And then 5,600, a key psychological level. Those are all puts. And clearly by this big blue bar, there's a lot more puts being played than there are calls. Now, if for some reason this ends up being super bullish, you might want to pay attention to 5,750 and then also 5,800. So those are all pretty easy to remember. I should also add on here with respect to seasonality, this is not necessarily the end all be all, but I do want you to know over the past 27 years, this upcoming day, i.e. tomorrow, has favored the bears 56% of the time and the bulls only 44% of the time. So the seasonality is slightly bearish, but it's not like absurdly bearish or anything like that. So that's pretty much the breakdown of the very boring day we had today, the things to pay attention to tomorrow, and some of the interesting facts that we have. The gap fill got that close to it. If we do snap the trend line, I see a big capitulation. We see a lot of active open interest on the put side specifically for tomorrow, which makes you wonder, does someone know something we don't? The seasonality is slightly bearish, but overall, the major thing you need to know, over the past couple trading sessions, the overall option chain has remained put dominated, not only for the remainder of the week, also for all of next week, and also the entirety of the chain. So as that starts to get a little bit more constructive and repair a little bit, obviously I'll let you know, but I would say as of this moment, the bears are currently in the driver's seat, and that might not really be changing until either the JP Morgan position burns off on Monday, March the 31st, or maybe 2 days after that, next Wednesday, when we get the update for the April 2nd Liberation Day with relation to the reciprocal tariffs. That's what I have for you. I appreciate your time. I appreciate the good vibes. Let me know if you have any questions in a comment below. And other than that, I'll catch you in the next one.